Joining me now is ERShares CEO Joel Shulman. Joel, great to see you. Do you see this kind of euphoria around tech ETFs right now? What's your reaction to all of this?
Well, this week, last week was a tough week in tech and certainly overall in the markets. This is a big week. We've got 25% of the Russell 1000 growth coming out the next 24 hours. We had Tesla this morning, actually after hours yesterday, and it's way up based on some announcements. Meta, I think, is going to be the big winner. It's already looking strong pre-market. Their earnings dominate. They've got a moat. A lot of people may not realize they have 3.6 billion customers around the world. 77% of all the internet users use a Meta application. So they're well positioned long term. Of the Magnificent Seven, I think it's actually a Mag 6 asterisk. Tesla fell off 41% so far this year, although they're catching up something today. And then Apple has also brought down the Mag 7. So those two stocks, Tesla and Apple, brought down 3% of the Russell 1000 growth. But the others are fine, and I think we're seeing a lot of companies coming out with strong earnings.
Adam Johnson, jump in here.
Yeah, well, Joel raises a very important point, and that is, if you look at the Magnificent Seven, it's not necessarily seven so much anymore as it is five.
Okay, right? I was going to say 4 or 5.
Yeah,
You're called it the Fab Four.
Yeah, the Fab Four. So, Joel, I'm with you on that. And yet, if I look at those Fab 4 or 5, it's pretty impressive. They're all growing at about 20 to 25% and trading anywhere from 25 to 30 times. So it's not that they're cheap, but they're so consistent. I'm comfortable owning them. Are you?
Well, we like Meta. We're very strong in Meta. We haven't owned Apple in many years. We're very strong in Google. Of course, we're Alphabet. You can't avoid NVIDIA. We've been in it for over 10 years. We got in, it was $5 stock. There's some near plays of this. SMCI is another strong play, which peaked at 1,200 and dropped to 700. It's the strongest performer. The S&P 500, which it recently joined. There's some tech companies, for example, Spotify announced yesterday that their earnings are up. They just turned the corner. And what we're seeing now is many tech companies are expanding margins, cutting costs, widening. They're increasing gross margin, which is what Spotify's done. They cut their SG&A, sales general administrative. They widen the EBITDA margin, and they turn the corner from losses to profitability. So the market responded strongly yesterday. They're way up. There's another company we like called App11, which is a tech company, which is strong. But we also like some companies that are in the payment business, very similar to a MasterCard and a Visa. There's a company called FleetCor, which does a corporate payment system. They actually recently changed their name to Corpay. Okay. And that's a strong, it's a steady eddy. It's just making money in this market.
Well, we had a pretty good rally yesterday. The Dow up 263, the Nasdaq up 245. But look at where interest rates are this morning, Joel. The 10-year Treasury yield right now ahead of the first read of first quarter GDP, hovering around 4.6%. It's at 4.64%. That's up 4.25 basis points. We'll get the GDP tomorrow. Annual growth expected at 2.4%. We'll get the Fed's preferred reading on inflation, the March PCE index on Friday. But before all of that, in about a minute's time, we'll get durable goods orders. How important are these reports to you in terms of indicating where we are in the macro story?
Well, you've known me for a long time. I tend to be very bullish. Even when the market looks down, I tend to be bullish. I'm bullish this week. But overall, we've got to understand that inflation is not going to go anywhere anytime soon. We're going to be stuck in this 0.2, 0.3, 0.4% month over month. We're currently running about 3.5%. The Fed was saying they want to get it down to 2% or below. I don't see the Fed cutting the interest rates anytime soon. 2024 may be off the table, and we may be stuck. One of the things that a lot of people aren't talking about in terms of the narrative, we may be stuck at this level of inflation, the 2 to 4% range, for a while, because the biggest driver in this is shelter, and that's not going anywhere. You're going to see young couples, trying to start a family. They're going to be shut out of the housing market for many, many years. Many years. And this is going to be a fundamental problem. This isn't. And then we've got commercial real estate on the horizon with potentially $1 trillion coming due. They can't get insurance in many of these coastal areas. So the real estate problem, which by the way took China to its knees with Evergrande collapsing, and brought that economy down. things on the horizon. And again, I tend to be bullish. I like a lot of, this is a stock picker's market. There's some companies, they're doing very well. It's a winners. They're people taking the lunch of others, like NVIDIA, and some others are growing and others are losing market share. So it's not everybody's being treated the same.
Yeah.
But when the commercial real estate comes due, it's going to be tough around here. A lot of people may not recognize this.
Well, it's interesting. Steve Schwarzman, head of Blackstone, who is the largest owner of commercial real estate, told me he thinks rent is going down. He says it hasn't caught up with the numbers, but you're right. We have not seen evidence of that in any way. We're watching markets move this morning because durable goods orders is crossing. Joel, stay right there as we get this breaking news on durable goods orders. Jerry Willis, got the numbers.
So that top line, a beat. This is important here. Durable goods, a key measure of industrial activity, coming in at 2.6% increase against expectations of 2.5%. That's a beat there. When you look ex-transportation equipment, expectation of 0.3% gain, it was 0.2%. The core, right on the money, 0.2%. That's inching up for the core. This is, of course, something that the Federal Reserve will be watching. Maria, back to you.
All right, Jerry, thanks very much. Joel, your thoughts on the durable goods orders report? It's pretty much in line with expectation, although the Dow is now positive, up 10 points. Go ahead, sir.
The one good thing about this market, interest rates are rising. People are looking at the Fed, pretty much taking interest rate cuts off the table anytime soon, maybe for the year. The one thing that's keeping this market solid is the fact our GDP growth has not faltered. It's still running, 2.5+%. We went back in the last week or so. We've gone back over the last 40 years, 50 years of data. And generally, when inflation is kind of holding steady, if GDP does not drop, so those are the two drivers, right? And if inflation's rising and GDP is constant or falling, we're in trouble. If inflation's falling and GDP's constant, that's a good market. The only thing that's really keeping our markets, stable right now is the GDP is not falling off. It's strong. So we've got a strong economy right now. And that's what's driving us, even though it's been a little choppy and so forth with interest rate, cuts. People are hoping it'll be on the right side with interest rates coming down. Okay. Inflation's still down from last year, but I'm a little concerned it's going to stabilize in the 3.5% range, which means our GDP's got to be strong to kind of maintain the markets, being positive. And we have periods going back over the last 30 years where markets like this, and they were up for the year.
Right.
But but if GDP doesn't stay strong, we're in trouble.
Thank you, Joel. Joel Shulman joining us, ERShares. We'll be right back.